Hello everyone, this is a recording for the chapter 2, the mortgage glossary, and we will be talking about every section of this videos will be talking about 10 different terms that are used in the mortgage business. So the first term that we are using is called the adjustable rate mortgage ARM. Adjustable rate mortgage, which abbreviated for ARM. So if we're talking ARM, what's ARM? It's adjustable rate mortgage, which means its interest rate. There's two types of it. Let me put it that way. There is two types of interest rate. Two types of interest rate. There is fixed rate and adjustable rate. The fixed rate is fixed for the whole term of the loan. The adjustable rate is fixed for a specific period, and then it will start to adjust. Specific period agreed on. So I'm gonna eliminate the fixed rate here because we already explained. So this one, so here what does that mean? If loan, let me change the writing to red so that way we know. Example, if loan is for 30 years, the rate is fixed for the same length until loan is paid. Now, adjustment period. Adjustment period is basically an arm loan. Basically, an arm loan come to be fixed for a specific term, and then it will start to adjust, as we said in the previous. And here how it works and what you would see. How it works and what you would see. You would see for an arm loan, you would see it like this. 3, 1, 2, or let's say 5, 1, 2. What does that mean? The 5 represent years that the rate is fixed. So first 5 years the rate is fixed. The 1 represent that after the 5 years the rate will change yearly, and the 2 represent that maximum of 2% rate could adjust or could go higher on every adjustment. That's how it works. Now, buy down. Let me actually keep the I'll put this one a little below. Keep all these related to the rate together. Rate cap. Rate cap, like we saw here, there is a 2% rate cap of the adjustment per year. But also there is another type of rate cap. Another rate cap is the cap of maximum rate it can reach throughout the term of the loan. And that could be what we would see. We would see 6% or 8%. That would be, or 8%. That would be 8% on top of the initial rate. So let's say I'm going to put the example. Rate cap is 8%. Let me change the writing to red. Rate cap is 8%. And starting rate is 4%. That's when they got the loan. And fixed, let's say, for 3 years. After 3 years, rates are gone up, and they have a yearly cap of 2%. So the first year will go from 4% to 6%. Okay? So now it could keep on going up every year until it's capped at total of 12%. Once it reaches 12%, that's it. It cannot go higher than that. That's what's an 8% cap mean. Index. And there is another part. I'm going to put it closer. I'm going to put them together actually. Index and margin. What is the index and what is the margin? Index, any adjustable rate consists of index and margin. Index is controlled by the type of rate that is used, like LIBOR or Treasury, and the rate is the index rate is decided by how the market is doing. That's the index. Margin is what the bank add to the index for their overhead and profit. That's how the banks make their money. Make their money from the margin. Interest is basically the amount. Interest is the amount of interest paid throughout the loan, or paid monthly with the monthly payment. lock-in rate. The lock-in rate means when a loan officer meet with a client, they could lock the rate for the clients on their first meeting, or after we open escrow, we could lock the rate, or after we have full approval, we could lock the rate. We don't suggest to lock the rate on first meeting, because if the transactions don't go through, don't proceed, that could cause us to have negative closing pull ratio. To our locks and banks, and if we have weak pull ratio, the banks won't lock for us anymore. Let me highlight this one. Buy down mortgage. What is buy down mortgage? Buy down mortgage is basically someone that we price their loan. I will do it as an example. It's an example. Someone, we price their loan at 4.5%, and they want to be at a lower rate to have a lower payment. Then they can say that they want to buy down the rate from 4.5 to 3.99, and that for lowering the rate, they have to pay what we call discount point upfront to have the lower rate. They're buying it down. The points consist of multiple points. Could be discount point, which is we explained to buy down the rate. Could be origination points. Could be points in the rate. So discount point is to a cost for the rate that is picked. Origination point is commission charged for either broker or bank, and it's upfront commission. Points and rate is a term to say going up or down certain points to the rate mean. Rate, example, rate at 4% would be par rate, would be a rate that has no cost. Now, if transaction is non-owner occupied, then rate could cost 1.5 points to keep it at 4%, or we could go higher in rate to cover the 1.5%, so there is no cost. So this is, we call them points, adjustment points. And that is our first section of training of terms. I'll see you on the next section.